My name is Andrew Stotz, and I want to welcome you to the Valuation Master Class Show. The Valuation Master Class Show today is going to be on global investment strategy ideas. It's Tuesday, January 6th, and if you want this PowerPoint, just message me at Andrew Stotz to get that. Just want to let you know, Valuation Master Class Show is sponsored by Valuation Master Class Bootcamp. The next one starts on February 16th, and you will get an additional $100 off if you send me a message, VMBC, at Andrew Stotz. All right, so let's get started. When we look at valuing companies, it reminds me when I first started as an analyst, I found a company I thought was very attractive, and it was in Thailand where I was living and working. I valued it, I forecasted it, I met the company. What I didn't take into consideration was that money was coming out of Thailand at the time. And with money coming out of Thailand, basically the flow of funds was out. So I may have valued it, let's say at 150, let's say it was at 100 at the time. I may have said this thing is worth 150, but the fact is it was at 100 and it went down significantly because of a theme that was going on, which was pulling money out of emerging markets. And that theme is part of what drives investing. So you can't just look at a stock in context. So I'm going to walk through themes today, and I want to welcome everybody here. And Adi Wairi, good morning. Good to see you. And thank you for joining. And if you've got any questions as I go through this, feel free to put them into the chat, as well as feel free to send me an email and I will send you this presentation. So let's go into the presentation. Hold on, I'm going to get rid of that. So the first thing I want to highlight is the theme that I think is a big theme, and that is that the Fed is going to reduce rates much lower than what people think. And how do I think about that? Well, as we can see, I can look at the probability weighted Fed target rate, which we can see coming down from 3.7 in January of 2026 to 3.2 by March of 2027. Well, I think that's going to shift massively down to where that dotted line is, where we'll see about mid-year this year, we'll see the Fed rate collapsing basically by as much as 1 percentage point, and then maybe go down another percentage points to get down closer to zero. Why am I telling you about this? Well, one of the things that we want to look for as an analyst is somewhere where we are different from consensus, and hopefully we're right. I would say I'm massively different from consensus here, and that is because the theme that I'm running with is that Trump is going to do anything and everything to get elected, to make sure that the House of Representatives stays in control of the Republicans. If he loses the House of Representatives in America in November, when the election is, it's over. He's a lame duck at that point. Now, he'll still try to implement his policies, but ultimately he'll lose his ability to really, really make a difference through all of his policies that he's trying to implement. So how is he going to do that? Well, first, he's going to try to bring down oil price, maybe. Maybe that's part of what's happening in Venezuela. And the second thing is he's going to try to make sure the economy does relatively well, and that's part of bringing down the interest rates. And more importantly, he wants the stock market to do well, and that's also part of bringing down interest rates. Now, the interest rates that ultimately matter in the economy are not really the Fed funds rate, they're the longer term rates. And it's going to be hard to influence those longer term rates, particularly if people believe that a reduction in short term rates is going to increase the risk of inflation going forward. And so there's a balance there. But I would say that that is a major theme that I'm looking at right now. Okay, so let's go back into the presentation, and that theme I just want to highlight where my view is very different from consensus. Also keep in mind that the interest now is almost $1 trillion, and if you can bring down the interest costs, it's going to have a major impact on spending. So let's start off by looking at global investment strategies for 2026 by trying to understand where performance was in 2025. So in 2025, the world equity market was up about 18%. That was driven mainly by Latin America, and Asia Pacific ex Japan was up 29%. Europe was up about 18%, North America about 17%, and ASEAN, where I live, was only up 7%. It's been a brutal time for the ASEAN, the Association of Southeast Asian Nations. So think Thailand, think Singapore, think Indonesia, Malaysia, the like. Next, I think we should look at sectors. And here we can see the communications services sector is massive, up 30%. Infotech, 25%. Materials, 23%. That's a pretty strong performance for materials. Financials, 22%. Let's look at the bottom of this. All those consumer-related companies, consumer staples, like, Kroger as an example, or big companies like Home Pro or Walmart, not a good time. Energy. This is interesting. I think you see energy was up by 7%. Obviously, I believe that Trump is trying to push down the oil price. Let's look at this for a moment. Oil price drives energy valuations. And Trump is trying to push down the oil price because it also drives inflation. It feeds through the whole economy. And so what I think can happen is that oil price continues to fall in the next 6 to 12 months, let's say at least up to the election. And as oil price falls, energy companies aren't going to do well. But I also believe that the market to some extent has factored that in, and we can look at the energy sector at another time, or I can look at it in more detail. But I can say that energy sector is not very expensive. In fact, it's cheap. And so my feeling is that the energy sector eventually is going to see oil prices come down, and then we're going to be at the bottom. And at that point, I would say energy should become a good trade going forward. Whether that is 6 months from now or 12 months from now, it's still a while away. We still have more downside probably for oil price because of the election in particular. So this gives a picture of what's happening, and also what's happening, where the real performance has come in 2025. So let's then dig down deeper and look at countries. So I made this table and I've sorted it by country. And what we can see is the best performing country in 2025 was Korea, followed by Vietnam, followed by Colombia. So that's part of Latin America. Peru, part of Latin America. Chile, part of Latin America. So we've seen a strong performance in Latin America that we saw earlier. Now, we can also see that China H shares were middle of the road, up 27%. China A shares about 22%. And then look at the US, up only 16%. US has had incredible performance over the last 10 years or so. But here we can see the US at 16.3 versus the world at 18. It's probably been one of the first times in a long time that the US hasn't been leading that. And I'm going to highlight two other countries. Thailand, where I'm living, is down about 5% when the world's up 18%. Poor Thailand. So much going on that's hurting the economy. In fact, I'm going to do a special on Thailand, but also Denmark. What the heck's happening there? Well, I'm going to show you in just a second so we can get a picture of this. So one of the things that's interesting is that the US is not leading the world markets. In fact, the world markets are being led by, as we saw, Latin America and some other countries. But the US is lagging behind a bit in the performance. And that brings us to one of the themes you could have, which is maybe it's emerging markets versus developed markets, or is it non-US? So we do have some ETFs that are non-US. Maybe non-US stocks are going to outperform. That's a theme. And today we're going to review a lot of themes. I'm not going to necessarily tell you what themes I think, except the one I just talked to you about, which was prices coming, or sorry, the Fed funds rate coming down. I also think another theme that I'm interested in is, when does oil price bottom? And that, I think, is a theme that's going to take some time to go on. And I think tomorrow I'm going to go through my strategy in more detail, but I think it's good to get a picture of various strategies that we can consider. So let's continue on with our numbers. And next, I was just digging down, try to understand, okay, Andrew, you said consumer services. What do you mean? Well, that's Alphabet and Tencent. Alphabet was up 41.8 and Tencent was up 28.8. Now, remember that this consumer services, I've already shown you the performance of that sector, communication services, but this is the sub-industry called media and entertainment. So media and entertainment was up 27.6. That's not going to match the table that we had earlier, because the table that we had earlier basically was the whole sector. Let's look at Tesla, up 34.6%, incredible, outperforming autos, the best performing autos. I'm just looking at the companies that have had massive performance. Alibaba in consumer discretionary distribution and retail was up 44.5. Home Depot, despite the sector not doing that well, was up 19.6. Healthcare, we can see Johnson & Johnson and AbbVie up 19 and 16.3. And then industrials, we can see General Electric and Caterpillar. Both are part of, a recovery that's probably happening in the US and around. And this maybe is the investment theme of the reshoring in America. Now, the next one that looks interesting is Infotech. And we can see, I'm not necessarily ranking these by return, but you can see the highest return was SK Hynix. And we can see NVIDIA was up 18, Broadcom 38.8, TSMC 21, AMD up 25, and Micron Technology. Within the Infotech software space, it wasn't a great year, up only 7.8 for this sub-industry, but Oracle was up 44.8 and Palantir was up 21.8. And then in the Infotech hardware and equipment, Apple was up 22.2 and Samsung 37.7. The reason why I'm going through these sub-industries and these companies is just whenever we talk about the performance of the market or the like, it's always fun to dig down to see what companies were performing well in that period of time. Yeah. So now let's continue on and look at the next one. So here we can see, I went by kind of the big markets and some markets I was interested in. There's 4 Chinese companies that were up more than 100%, which is incredible. And these, in fact, the list is pretty long. So China has had some recovery in some of these companies. Now, what was going on with Denmark? We can see Novo Nordisk is the big company in Denmark that's down 24%. And you can see the other ones. There's just not a lot happening right now in Denmark. Another, Vestra Wind Systems, which I believe was a company in the CFA Research Challenge in the past. I can't remember, but I think so. And wind and solar is not being pushed that much, let's say, globally. So what about Japan? SoftBank up 100%, incredible. Part of it from their investments. But if we look at some of these other companies, we can see Central Japan Railway is up 38%. That's one of the companies that we had in the Valuation Master Class Bootcamp. So that was an interesting one. And within Korea, SK Hynix is the one that we talked about earlier. Samsung's got 2 of them in there. And let's look at Taiwan. Taiwan's got Delta Electronics, which is up 112. Anything related to electronics and electric is pretty significant. And within Thailand, the subsidiary of Delta Electronics, Thailand was up 64%, so about half of the parent company. And then one of the largest companies in Thailand, PTT and Advanced Info Services, both not doing that particularly well compared to the global average of 18%. Now, in the US, we're going to see all the companies that are basically above 40% in improvement. And we can see Warner Brothers, which has been in some things going on there with acquisitions. And interesting to see First Solar up 46%. And Oracle, of course, as I mentioned, 45%. And also some of these are like ADRs that are listed in the US market. Alphabet up 42%. So these give us a picture of what's going on in the individual markets. I got one point is I didn't think that Egypt did that well. Well, double check it. Maybe I'm wrong in my numbers, but I believe I'm right. How much did Egypt go up? And when you do that calculation, try to look at it on a local currency basis and a US dollar basis. There's two different ways generally that we're looking at it. For someone in a domestic economy, we'll look at the local currency performance. But if we wanted to look at it from, let's say, the eye of an international investor, they're often going to look at it to say, what would I have earned in US dollars to remove the currency impact? So let's now go back into some of these themes for a moment. And the first one I wanted to just mention is the structure is that I wrote, I will introduce first the theme, and then I'll consider whether that theme worked in 2025. The reason why I'm doing that is to try to understand, is this theme an old theme or a new theme? And then I'm going to propose one ETF that could provide exposure to it, but no guarantee. It's just a first pass. And then I'll explain the risk or reason why this theme may not work. Now, these themes aren't recommendations, but they're part of the research process that we want to go through and look through the themes. So let's start with the first one, quality earnings with pricing power. Well, in 2025, this worked because largely tracked the broad equity strength. We can see the ETF in America is global quality. This would be quality companies around the world. One of the ways to think about quality companies is just there's low quality companies that they remove from the universe. So let's say they have, in fact, if we look at Vanguard VT Fund, it owns about 10,000 companies globally. And I'm sure that ETF that we just looked at has a lot less company probably than that. But more importantly, let's say they have 3,000 companies, they may remove 500 or 1,000 that are low quality companies to make sure that they have high quality company exposure. Now, what's the risk that this won't work? Well, a liquidity driven rally favors these low quality cyclicals, right? So if you decide I'm going to follow this particular strategy by this global quality ETF, the risk that you now have is that nobody cares about quality in 2026. What they care about is catching a turning point and low quality goes up. So you could underperform if this one doesn't work. Let's look at the next one, investment grade credit for income stability. So what does that mean? That means bonds, investment grade bonds. So ultimately in 2025, income helped, but price returns were modest. So bonds were kind of relatively flat. And the way that you would play that is the iShares IG corporate bond. That doesn't stand for Instagram, by the way. And the idea here is we have a few different corporate bond ETFs, and we can use those to say, I want to get that exposure. Now, the risk here is that growth shock leads to wider credit spreads. And that could mean that the lower quality of these corporate bonds could fall in value, and then you wouldn't necessarily perform that well. Another problem is that if you go heavy weighting in investment grade credit, then you could run into a risk where equities fly and then you just don't have exposure. So these first two that were looked at is global equity and fixed income. In fact, you could think about it as that 60-40, 60% stocks, 40% bonds, typical allocation. So let's continue on to the next theme that we could think about for 2026, and that is U.S. equity earnings leadership. In other words, already in 2025, we had huge performance from earnings growth and multiple expansion in U.S. companies. And the question is, will that continue? Now, if you're of the opinion that I think that U.S. earnings quality is still going to remain strong and have good momentum, then you would own the S&P Vanguard 500 fund, because with this particular ETF, you would get exposure to the highest quality, generally the largest companies we would consider to be the highest quality, and that would allow you. Now, the problem that you face is the risk you're running is that valuation compression. We could see valuations fall, and you had to wish that you were in fixed income, or there's a rotation away from the U.S., and U.S. just doesn't perform when you compare it to the rest of the world. I think that's a very real possibility, is that we've seen the end of U.S. outperformance relative to the rest of the world. I think we could see in 2026 outperformance in the rest of the world. In particular, I think emerging markets could look interesting. Asia's been underperforming for a long time, so I think there's a possibility that we're going to get some of that flow back, but we'll see. So next, inflation-linked global infrastructure assets. Now, infrastructure assets means tollways and things like that. Now, this in 2025, it lagged because equity beta dominated returns. Basically, equity did really well, and generally, infrastructure doesn't do that well in that case. But if you wanted to play the infrastructure theme, you would buy iShares, in this case, global infrastructure. Now, this is not a recommendation, and also it's not advice. There may be better ETFs, but I just gave you an example. And the problem you could face is higher real yields could pressure valuation. And if we have higher real yields, it could be that people just would hold on to government bonds as an example. Now, infrastructure is an interesting sector. That's what we're talking about here, because it tends to be less correlated to the overall market. So sometimes infrastructure can act as a defensive portion of your portfolio. Let's continue on and look at the next one, and that's the AI physical build out and CapEx cycle. Now, we all know what's going on. AI is taking over the world, and in fact, it underperformed as earnings lagged that narrative. So one way you could play this is take the AIQ, the Global X Artificial Intelligence ETF. It's not perfect, but it's not a bad ETF. But the problem that you face is CapEx pause. These companies pause their CapEx, or there's a valuation derating. I think that the theme related to AI is interesting. The first thing I say about AI is never let your kids get anywhere near it. It's going to destroy their brain. But besides that, what you're probably going to see in the AI space is standalone companies like ChatGPT are going to have a hard time surviving, because the CapEx needs are massive, the cash flows needs are massive. And so what you'll see is companies like Gemini, or companies like Google, Gemini, and Microsoft, and others that can bundle. Even look at Grok. Now, you could say, well, isn't Grok a standalone? Well, not really. You can bundle Grok with X, with Twitter. And the bundling basically allows some compensation to come from the other part of the business. So I would say that what we're going to see is a consolidation of AI. And therefore, Gemini, as an example, within the Google space would continue to outperform, which we saw previously that Alphabet has done very well. So this is an interesting one, to think about the AI CapEx cycle. Now, this is one that we've made some good money on in the past, and that's the Japanese governance-driven equity re-rating. Of course, we already got the Korea re-rating, but now let's see. In this case, we had moderate gains driven by valuation, but not really global beta. And ultimately, it wasn't a huge performer in 2025. Now, if we wanted to play it, one way to do that is through the iShares MSCI Japan. And the risk is we get some yen strength or global export slowdown, which could dampen the market. Remember that the Japanese economy is dependent on manufacturing around the world. And so if the yen is strong, then when money's coming back from those, it tends to come back at a lower rate. So Japan is an interesting one. Also, they're facing a possible crisis with their interest rates rising. But it's important to note that Japanese companies, as well as individuals, don't have that much debt on their balance sheets. The next one is India. Speaking of India, DP says, very insightful sector by sector breakdown, essential perspective. Yes, thank you. So India, well, we've got a domestic growth story and we've got good demographics. So the problem is in 2025, it was mixed returns. Valuation is very high in India. And I think that that's the risk we can see at the bottom is that, well, people aren't interested in emerging markets. If that happens, then India is going to have a hard time performing. And we could say that people look at India and say, it's too expensive, and therefore this trade would not work. And let's look at the final one. This is gold. Gold as fiscal and geopolitical hedge. Now, of course, gold has been a strong outperformer and a clear winner in 2025. One of the global ETFs, the gold ETFs, is the Spider Gold Shares as an example, and there's others out there. So what's the risk? Well, the first risk is that gold's already gone up quite a bit. So there's a possibility that gold doesn't go up any further. The second risk is rising real rates and a stronger US dollar. Remember that gold is a non-interest rate yielding asset. And that means that if real rates were to rise, then people would say, well, why do I hold gold? I can get a higher and higher return in absolutely risk-free US government bonds, as an example. And the other thing about gold that we could look at is the stronger US dollar. Now, in my investment strategy, I have a portion of it, 60, 70, maybe it's 40% allocated to the US. And of that 40%, I also have 25% allocated to gold. And you can say that I'm hedged relative to the US dollar, because if US dollar is strong, gold is weak. And if gold is strong, it usually means that US dollar is weak itself. Well, I went through a lot of stuff there, and this presentation is a fun one for me. And if you want to get a copy of this presentation, just send me a message at me@andrewstotz.com to get that copy, and I'll send that PowerPoint to you. Just send that to my personal email. So there we go. Another edition of Valuation Master Class Show. Remember, Valuation Masterclass Bootcamp is starting on February 16th. So I hope to see you in there and join. Feel free to send me a message with VMCBC to get the discount, or just send me a message and ask any question that you may have about it. My name is Andrew Stotz, and I hope that you are building a competitive